All right, between 2021 stock market, politics, pandemic, I mean, the vaccine's coming out, good news, right? But a lot is going on. I am doing my housing and interest rate outlook right now. So here we go. Meant to get this out a lot sooner for you guys, but with rates and everything and with the Senate winning, we had to do some adjustments on certain predictions. So here we go. Let's get started. First of all, it is true. She is back. Janet Yellen, former Fed chair, is now Treasury Secretary. And the Treasury Secretary, if you don't know, gets to sign all the money. So you'll see her name right here moving forward. And they say Janet Yellen has never met a spending program that she didn't like, and she's very different than former Treasury Secretary Stephen Mnuchin. Now, Stephen Mnuchin butted heads quite a bit with the current Fed chair, Jerome Powell, maybe just a little bit. But Jerome Powell believes that the Fed should be involved in just about everything. And we do receive some benefits from that. That is a big part of why we've seen mortgage rates so low. But Jerome Powell has been so aggressive that he's been buying bonds and things like McDonald's and Apple. And, a concern maybe, do we really need the Fed buying Apple bonds right now? Now, Stephen Mnuchin wouldn't think so, but Janet Yellen is a big green light spender, and she thinks that's not enough. Do more. And so that's a growing concern, which the bigger concern could be inflationary, leading to higher mortgage rates. So we don't know what will happen, but I can tell you this, since there is a direct correlation, I should say, from the day that Janet Yellen was appointed to the rise in gold, the rise in silver, and the enormous rise in Bitcoin, right? And it's believed that all this will debase the American currency, and it will make these fixed assets gain in value. Now, is it being a bit overdone right now? It's too early to say, perhaps. But the dollar is losing value, and the dollar has sank since then. And that does tend to be a rise in inflation, because if the dollar is sinking, it's going to cost a lot more money to bring things over here. And so there you have it. Also, with this blue wave, right, we're going to see additional inflation. And the bond market hasn't liked that to start the year off. And we have seen mortgage rates really get affected and hit hard by that, especially in February. Now let's look at interest rates and the federal funds rate. So we do see here, we've got 30-year fixed rates in the blue here, and we have the federal funds rate in red. And you can see there's a pretty good correlation. They kind of correspond. But I will point out, from 2009 to about 2017, federal funds rate you see here was about 0. But interest rates went from 4 to 5 and an 8. We love, mortgage loan officers hate when this happens, by the way. Like, changes your entire year. But anyway, moving on. And then it goes to 3.5 to 4.75 a couple years later in 2014. So we can see the Fed rate can be at 0, but we can see rates, Fed rate being at 0. Here's an example. And mortgage rates are at 5 and an 8. Now, let's a couple years later in 2014. So we can see the Fed rate can be at 0, but we can see rates, Fed rate being at 0. Here's an example, and mortgage rates are at 5 and an 8. Now, let's take a look at debt and rates. Now, we're going to see rates here in blue and debt in pink. And whenever we have a lot of debt, you see, as debt rises, rates tend to go down, and this happens over and over again. And right now, we're not printing any money, we're issuing debt via treasuries. So initially what this does is create a little bit of economic stimulus, but after the debt takes over, all you have left is to pay that debt back, which leaves less money to activate economic growth, and it does slow growth. So as debt rises, rates do go down, and we can see here it's happening all over the world. This is France. Here we have Japan, Italy, the UK. There is an initial spurt which causes activity, and then there's debt. And so you imagine like when a family buys a car, they go out, they buy a car, they're happy, they just spent some money, manufacturer makes money, the dealership makes money, the salesperson makes money. But then all that's left when the party is over is just the payback. Now, rates will remain low, but we do think, what's going to help rates remain low, just like we talked about debt and technology, inflation pressured lower with these. The labor force is down, they say 10 million. I think there's actually more than that right now out of work, but hopefully they come back soon, please, right? And alleviate the supply chain. And what happens then is when there's more people back at work, we're able to create more because there's a constraint in the supply chain with people not being able to go out and work as a workforce. And so this will help alleviate inflation and reduce pricing. All this spending we're talking about and treasuries being sold, that will keep interest rates down as well, because a lot of these are going to the federal, to mortgage-backed securities. And then rates are likely to bump a little higher before we resume this downward trend. All right, now what about housing demand? Now, first of all, we're going to see explosive growth in the next few years. Why is that? Because basically 33 years ago, a lot of people had a lot of babies, and now they're becoming 33-year-olds, and 33 is the median age for the first-time home buyer. So that means we've got not a new 33-year-old, aka first-time home buyers, entering out into the marketplace these days. And so that will create a huge demand moving forward. What else is going to cause a huge demand, of course, is the lack of inventory and the lack of new construction. Look at this. Over the last 10 years, there's been this huge shutdown and a lack of supply, which is causing prices to go up. Of course, it's causing homes to sell quickly, and it doesn't look like it's going to go away anytime soon. Next, vacancies are at an all-time low. So with vacancies at an all-time low, there's no incentive for sellers to drop prices anytime soon. And then look at inventory levels that we have, which peaked in 2007, and they're at like an all-time low in 2020. So again, housing is going to be a tough market to get into, very hot market. Will it be a good time to buy? We're going to see interest rates remaining very favorable and a high demand and a tight supply. We're expecting 6% appreciation in 2021, so it may not be a bad time. I'm Garrick Wordmuller. Appreciate you watching this. I hope you enjoyed it. Please like, subscribe, and do all that cool stuff. Here's my information. There you go. There's my information. Let's leave it on here a little longer for you. Independent mortgage brokers that work for the people.